Good morning, everyone, and welcome back to another workshop presented to you by the Taxpayers Help Center. My name is Amiel Duncan, and today's topic is going to be what's changing in 2026, how expired tax cuts affect you. So, a little bit about us as an organization. Once again, we are the Taxpayers Help Center, which is a nonprofit organization located in Northridge, California. We do operate two tax clinics, the first one being our LITC, which is the Low Income Taxpayer Clinic, where we help taxpayers resolve their tax disputes with the IRS. And then our second clinic being the VITA Clinic, also known as the Volunteer Income Tax Assistance Clinic. Here at the VITA Clinic, we help prepare income taxes for free. Masu Shatani, he's the CPA director for both clinics. And then once again, my name is Amiel Duncan, and I am the director of the outreach program for the LITC. And our mission as an organization is to help taxpayers both locally and beyond. We are an IRS authorized certifying acceptance agent, also known as a CAA for the Individual Taxpayer Identification Number, also known as I-10s. So if you yourself or someone you know is in need of an I-10 application or just has questions about the process, please feel free to reach out to us today and we can go ahead and help you get started with that process. And then lastly, for donation and support, individuals and businesses can support us financially by donating funds to help us expand the reach of our services. They can also volunteer their time or expertise or simply spread awareness about our services and our organization to loved ones. So with that, once again, welcome and thank you guys for joining today's workshop, hosted to you once again by the Taxpayers Help Center. This presentation is focused on helping everyday taxpayers understand the impact of the expiring provisions under the Tax Cuts and Job Act, or also known as the TCJA. Passed in late 2017, the TCJA made sweeping changes in the individual and corporate tax laws. Many of those changes were temporary for individual taxpayers and will automatically expire at the end of 2025. If Congress does not act, we will see a significant reversal of tax policies in 2026. So this does affect tax rates, deductions, credits, business income, and even estate planning. So our goal today is to explain what's changing, who stands to lose or gain, and how you can start preparing now to avoid a surprise tax bill in 2026. Now, why does this matter? So the TCJA dramatically changed how we calculate income tax by increasing the standard deduction, lowering individual rates, and altering several key credits. However, these were not permanent changes. They were sunset provisions set to expire after 2025. The result is that unless Congress passes new legislation, the tax code will revert back to its 2017 version starting in 2026. For many people, that means higher taxes, especially if they benefit from the expanded child tax credit, lower brackets, or increased standard deduction. So by understanding what's changing now, you can plan for your finances and avoid being blindsided in the next upcoming years. So overview of expiring provisions. So we do have our low income tax brackets. So across all levels, this means higher marginal rates. And then we have the standard deduction, which will shrink, which could mean fewer people benefit from it and more will go back to itemizing it. And then we have the child tax credit. This will be cut in half and will have a stricter eligibility requirements. The $10,000 cap on state and local tax, the SALT deductions will be lifted. The qualified business income QBI deduction, which gives small business owners a 20% write-off, that will expire. The exemption thresholds for the alternative minimum tax, the AMT, and for the estates and gift tax will return to much lower levels. So all of these changes combined could increase taxable income, reduce credits, and raise taxes owed for a large portion of Americans. Now, the individual tax rate revert. So the current tax rates are lower than what existed before the TCJA. When those provisions expire, the rate structure will revert to what is or what was in 2017. So this means, for example, someone currently paying 12% could jump to 15%, and someone who is in the 22% bracket right now might jump up to 25%. So the top marginal rate will go back to 39.6% from the current 37%. So everything is going up. Even the modest income levels will see a tax increase because of the bracket changes. This will especially affect middle class earners. So right now, our current brackets, we have our 10% bracket as our first one. Second would be 12, third 20 or 22%, four 24%. Fifth bracket is at 32%. Our sixth bracket is at 35%, And then our last bracket is at 37%. So that's what it's currently at. And starting in 2026, the brackets could go up to 10% being the first one, 15% as a second bracket. Then we have 25%, 28%, 33%, 35% for its sixth bracket. And then for the last bracket, it would be 39.6%. So higher marginal rates equal more tax owed on the same income. Now, standard deduction cut in half. So, under the TCJA, the standard deduction was nearly doubled. This change simplified filing for many people and made itemizing unnecessary. Starting in 2026, the standard deduction will be cut nearly in half. So, many taxpayers who haven't itemized deductions in years may now need to track and calculate things like mortgage, interest, charitable contributions, and medical expenses. So this increases complexity and can reduce your overall deduction amount, meaning higher taxable income. So if you are married filing jointly, this will drop from about $29,200 to about $14,600. For our singles, this will go from about 14,600 to 7,300. If you are uh, if your status is head of household, it will drop significantly as well, and more taxpayers may itemize again as well. So now we have the child tax credit cut in half as well. So the child tax credit is one of the most impactful changes under the TCJA. It currently provides a $2,000 per child credit with up to $1,600 refundable. In 2026, the credit will drop to $1,000 per child and be much less accessible. Phase outs will also begin at much lower income levels, which means middle income families could lose some or all of the credit. Refundable credits often create large refunds for families, so this change could significantly reduce refund amounts for families with kids. So it will once again drop from $2,000 to $1,000 per children or child per child. It is a refundable portion that goes down or away, and the phase out thresholds do drop sharply, so from $400,000 to $110,000 for joint filers. Now the SALT cap does disappear. So, one of the most controversial provisions of the TCJA was the $10,000 limit on SALT deductions. This cap disproportionately affected residents in high tax states. So the expiration of the cap will allow taxpayers to deduct the full amount of property taxes, state income taxes, and local taxes again. However, only those who itemize will benefit from this, and that tends to skew toward higher income earners. So the current cap right now is at $10,000 in 2026. Full deduction for SALT does return, and then mostly benefits higher income earners and high state taxes. Now, business pass-through deduction ends. So this deduction has been a game changer for a lot of small business owners. It allowed for 20% deduction of qualified business income from pass-through entities. Its elimination could result in much higher tax bills for sole operators and others operating under pass-through structures. And then entrepreneurs, consultants, and freelancers should especially be aware of this. So once again, this does end in 2026. It applies to self-employed partnerships, LLCs, or sole corporates or S corps, and then may raise tax bills for small business owners. Now for the AMT and estate tax changes. The AMT, or also known as the Alternative Minimum Tax, was adjusted under the TCJA so that fewer people were impacted. That will change after 2025 as more taxpayers, particularly those in the upper middle income brackets, could be pulled back into AMT liability. The estates and gift tax exemption will also drop, potentially exposing more estates to taxation. If you plan to transfer wealth to children or grandchildren, now may be the time to act. And then our key takeaways from this slide is that the AMT exemption thresholds will drop, estate and gift tax exemptions drop from about 14 million to 7 million, and then more households will be affected by this. Now, who pays more under pre-TCJA rules? So the middle class families are most affected by the loss of the expanded child tax credit and higher standard deduction. High income earners do gain back the SALT deduction, but they still lose the KBI deduction and face higher top rates. And then anyone with a sizable estate should also be alert, so the lower exemption could trigger significant estate tax liability. And then once again, the key and then once again, the key takeaways is that the middle income families lose child tax credit and pay higher rates. Higher earners lose SALT cap but pay more overall, and the larger estates do or can face higher estate taxes. So proposed extensions. So now we have proposed extensions, the one big beautiful bill. I'm sure we have all heard about this bill in recent news with our current administration. So on this slide, we have that the Congress could affect, or sorry, so Congress could act before 2026 to extend or modify the TCJA provisions. The One Big Beautiful Bill Act includes several extensions and improvements. It's passed in the House, but not the Senate. It offers relief on SALT, slightly expands the child tax credit, and preserves tax brackets. It's a political question at this point, so you should prepare as if the changes are coming, but monitor developments closely. Now, how to prepare now. So you do want to adjust your W-4 to account for higher taxes later. Maximize use of the larger standard deduction while it lasts. You should prepay stat and property taxes where possible in 2025. You also should consider converting traditional IRAs to Roth IRAs now if you expect to be in a higher bracket post 2025. And you should make estate gifts now to use the higher exemption while it's still available. And then I do have an example scenario. So these examples highlight the different ways taxpayers could be affected. So our first one is a single parent could lose half of the child tax credit and see a refund drop. Our second example is that a small business might pay thousands more without the QBI deduction. And then lastly, we have a homeowner in a high tax state may benefit from losing the SALT cap, but lose more from higher rates and deduction cuts. Alrighty, guys, and with that, that's going to cover everything that I have planned for today. Thank you guys for tuning in. If you have any questions related to this topic or any other tax topics or queries, please go ahead and give us a call. Our phone number is 818-366-0111, or you can send us an email at masood@taxpayershelpcenter.com. And then lastly, if you want to review all of the information provided today, please check out our Facebook page, which is Taxpayers Help Center, Inc., a nonprofit tax organization where this workshop will be uploaded. And then we also have previous and old workshops on there as well if you want to check those out. Thank you guys again, and I will see you next time. Ooh, bye.